You're coming on into a great show. This is Lowcountry Money Talk. We've got lots to discuss, as we always do, and expert Phil Bloyd is with us once again at the desk with Revolutionary Financial Group. So nice to see you.
Good to be here, Jessa, as always.
Well, we're going to start with some of our viewers' main financial concerns, which are, mine too. Boy, the state of our economy is a challenge. We know that. There's the pressure of inflation. It's putting pressure on our checking accounts. And we're going to dive into this just a little bit, talk about what the Fed has to say. Federal Reserve Chairman Jerome Powell says it's hard to predict what's going to happen next. Okay, not helpful really, but with the state of our economy and the state of inflation, we got something to listen to.
Let's hear it.
This cycle is different from other cycles because of where it came from, and it's just confounded all sorts of attempts to predict what it would do. It is good that we have seen a very strong labor market, but at the same time we're seeing wages moderating. Wage increases have come down, still well above what would be sustainable with 2% inflation. And same thing with inflation. Inflation is starting to come down and the labor market hasn't softened. We do expect that it will soften.
Okay, so for our viewers who may need a little sense making of that one, that's me too, actually. What did that say?
It's a word salad, okay? So basically what he's saying is that the job numbers are still too high and they're still trying to get what they call this soft landing, but it's not working just yet.
It's not working.
So they're going to continue to raise rates.
So they just keep going, okay, and see if they can force it to work, right?
Yes, too much money in the system, too little goods to buy with the money, so we have inflated dollars.
Yeah, and we're still spending.
Yeah, gotta spend.
Okay. Well, all right, let's talk about actual strategies because our viewers who watch are wondering how they can start preparing.
Yeah.
And boy, it's tricky because we don't know what's going to happen. We don't have a lot of folks helping us predict this, and we've got some confusing verbiage to sort of work through. But how can we prepare for things like higher inflation when we get into retirement? Because that's the picture a lot of us are facing right now.
Well, what I tell people, Jess, is, we can't really control the market, of course. If we could, I wouldn't be here, right? But we can control how much we want to invest in that system.
Okay.
So the first thing would be is make sure that we have the appropriate risk in the system. So if I'm 75, I probably don't want 80% or 85% in that at risk.
And this is the simple math that you've been teaching us here. So
we always talk about the rule of 100, but make sure I have a moderate risk on what I want to invest in that market as a percentage, not too much. On the other hand, make sure that most of my assets are in a lower risk situation, especially as I age, or if I'm getting closer to retirement, right?
So that picture needs to continue to adjust as you get older.
Sure.
The rule of 100.
Yeah, you don't wait and just contribute to your 401k and say, hey, I'm retiring tomorrow. I've been, 100% aggressive and the market just blew up on me and I'm down 20%. We don't want to do that.
You're in big trouble.
Right.
Yeah.
We want to also have a distribution plan. So if I'm retiring and I'm going to need money out of my assets, how much do I take? Where does it come from? So we want to have that. We're going to have an emergency fund with 6 months expenses. So that would require a budget so that I would know what my 6 months expenses are.
Right.
Look at your checkbook. You can just kind of go down and see what you're spending.
What are you spending per month? You need 6 times of that. Okay.
Social Security. When are you going to take Social Security? Know your options. Age 62, full retirement age, which could be 66, 67, 66 and some months. Do I want to wait till 70? And compare your risk assets to the benchmark. So on my asset side, if I'm taking this moderate risk, how are my risks performing against the benchmark S&P 500 index or something like that?
That's a lot. That's a lot to do,
well,
Phil.
The easy way to do that would be, we have a team to take care of that for you. So remember, not all financial advisors are the same. I'm local. I'm a fiduciary advisor. I specialize in retirement planning, and in the distribution phase, that's very important. This means that I can truly work for you and not the company. The Revolutionary Wealth Review consists of our team running a tax assessment, risk assessment, and a portfolio assessment. So arrange your assets to eliminate maybe lower taxes on your Social Security, use the rule of 100. That's what we talked about here. Don't put too much at risk, especially in this market.
And you know, it sounds like a lot to sort of unpack, and it can be confusing for folks to really work through all of this. So it's a great time if this sounds like something you're ready to dive into, and make sure you have a great strategy to take advantage of Phil's offer, and go ahead and call the office. Call Rachel. It's completely complimentary, so go ahead and get your Revolutionary Wealth Review. There's no obligation, but you should have at least $500,000 of investable assets saved to be able to take advantage of this. And we want you to take advantage of a great show, because we've got lots of it left.
Yes.
You ready?
Yes.
We're gonna go to break.
Okay,
But
we'll
be
come back.
We'll be right back. Back as promised with lots of great advice, and we're going to unpack some things for viewers right now. Phil Bloyd is returning with us, expert from Revolutionary Financial Group, and gosh, it's nice to have you.
Good to be back.
You know, we've got a lot of questions. In
Sure.
fact, Phil, folks who are watching this show sometimes ask me questions, and I'd love for you to help kind of simplify some of this. You know,
Sure.
when you're working, and a lot of our viewers are in retirement, but you know when you're working that most of your savings is going into 401k of some
Right.
kind. You might have a match, you may not, but let's work through the two different types. There's a Roth 401k, and then there's a traditional 401k, and same for IRAs. So
Right.
demystify this for us between a Roth IRA, a traditional IRA. What are the difference between these
401ks.
four items?
Yeah, and 401ks.
Yeah.
So most employers now offer Roth 401ks.
Yes.
So as I'm contributing into this 401k or IRA, well, same thing, well, different, but let's just say, in a Roth 401k, as I am contributing, I will not deduct that from my income tax.
Okay, right.
So people say, well, it's saving me tax money. Not really. You're just deferring the taxes
Right,
for later.
so you're
time.
not paying it now. You're kicking the can
Yeah.
down the road.
We call it tax deferral.
Yes.
Not tax free. Okay.
Okay.
In a Roth, as I'm making the contribution, I don't deduct it or defer it, but the gain that comes on top of that is going to grow. There's some rules involved, okay? We don't have time to get into all those.
Okay.
But technically, the gain that I'm getting from the investments over time, when I take that out, I won't pay any taxes on that,
Okay, so
Okay.
on the gains.
on anything.
On anything.
Because I didn't deduct the contribution, see?
I got it.
Now, if I
Okay.
do a regular 401k, we call that pre-tax or tax deferral. All of that's just building a balance that you're going to have to satisfy with Uncle Sam later,
Yeah.
at whatever their conditions are later.
Okay.
So, you know, in most situations, I prefer the Roth because you know, in a growing stock market, wow, that's really going to work to your benefit. If I defer those, that growing stock market is just going to mean that when Uncle Sam decides they want their money, I'm going to have to pay them dollar for dollar on whatever I take out of that thing.
Okay.
Okay.
Well, let's just ask the blanket question then. How can we make our retirement savings the most, or at least more tax efficient?
Tax efficiency. Okay. Great opportunity, great question. Right now, if you have an equity portfolio, meaning a growth or it's stock oriented or growth fund oriented, you know, it's been beaten down probably 20, 25, 30% or more.
Yeah.
So the thing we might consider for tax efficiency is let's go ahead and look at our return and see if we can go ahead and do some conversions now while the asset is in a lower taxable stage,
Right.
but move it over or convert it over to that Roth from the traditional, so that as it grows back, that we've already kind of settled our taxes.
You've done that. You've
Yeah.
paid Uncle Sam
Yeah, right,
at a time
right.
where the rate was lower.
Right.
It's such an interesting strategy, and
Sure.
I've learned that on this show, something that is a sort of counterintuitive to me and maybe some of our viewers. Just go ahead, pay the taxes now.
Yeah, we know what they are now.
Right, there's no question
And we're in a
marks.
lower income tax rates now through 2025, then they sunset, and we're not sure exactly
Right.
what that's going to look
Right.
like. But I have people that come to me all the time, Jessa, they're like, Well, you know, my last financial advisor didn't ask to see my tax return, so why did you?
Right.
And I'm like, well, I'm a fiduciary, so the thing I want to, if I'm working for you, it makes sense to me that I want to know how much taxes you're paying on your Social Security. I want to know, hey, would it make sense in your at your tax rates to go ahead and do some Roth conversions? Okay. The other thing, do I have any capital loss carry forward that I could use to your benefit when we're doing a distribution plan for you? You know, so if I'm not looking at that, or I say, well, hey, you know, you asked me an investment tax question, and I say send your CPA, and your CPA says, well, it's what your investment guy is doing, is messing up your taxes or whatever. I want to look at the document itself. Then I can work with your accountant or whoever it may be, or you could be your own accountant. But you know,
how can
very
you
important.
see if we're being tax efficient if you don't know exactly what those taxes look like on the returns?
When I look at your tax returns, it will tell me a lot about you.
So you need that information. Yes.
It's very important, and it's for you so that when we're setting up a distribution plan, we went over the buckets in previous programs. We need to know what is the most tax efficient way for you to take withdrawals to supplement your retirement.
Okay, sounds good. So you can actually take advantage of a tax analysis. There's no obligation, so if this might sound like something you want to do, if you have $500,000 in investable assets, go ahead and call, get this taken care of.
And one thing, we'll look and see if you have an IRA to Roth conversion strategy, and if it makes sense, the team will do an analysis for you on it.
I think that's great. Well, no time like the present. We're gathering documents anyways for tax time, so it's a good time to take a look. And it's a good time to stick around because we've got a whole half of a show left after the break.
Fast.
Be right back. Welcome back in. I told you before the break we had half of a show left, and we have a great back half.
Yes.
Don't you
Goes
think?
fast.
It does go fast, boy. But what we've been talking about today, for our viewers who are just tuning in, really all boils down to retirement and whether or not you're ready to retire. I know a lot of folks have that question, and sort of how to budget for all of this. There are folks, of course, who want to retire before they're coming of age 65. That has some other considerations to make. Walk us through that a little bit.
Sure. Well, okay, so Medicare is at 65. Depending on if I have a employer-based plan or I don't, you may have to say, well, if I retire at 62, I'm going to need to have some health insurance, you know, for 3 years. How much is that going to cost? Where will I get it? You know, all these kind of things. So that's a major consideration.
Right, and if you haven't properly budgeted for that, you've got this whole other expense that you maybe didn't plan for.
Sure.
So I guess we need a budget.
Large expense.
It could be a large expense,
Yeah,
right?
so we need to look at the budget, see if it makes sense. You know, in volatility like we've been in the last few years, people are still having, you know, should I retire? Should I wait? Should I this or that? But unfortunately, what's going to happen, you're seeing a lot of layoffs now.
Right.
So you're going to see even more as Chairman Powell's plan takes place. You'll see more and more layoffs coming. So you may not have a choice.
Right.
So we better have a plan.
Yeah, you might be forced into retirement a little prematurely.
A little early.
Yeah, then you do need a plan.
Right.
But that's part of what you're doing here, is you're making sure your clients have a plan.
Yes.
And also that, I guess, they're staying on track.
That's the hard part.
You're like a life coach.
Well, so we develop the plan, and then we need, you know, that Marine drill instructor to keep us on the plan.
Yes.
Because we have, you know, some people have disciplinary issues.
I have
And
no
it's
idea
like,
what you're talking about.
I'm chasing this rabbit down here. So, you know, just a lot of my job is like reminding people, hey, this is the plan we established. And, you know, in life, things are going to come up. And it's like, okay, let's see how we're going to handle this problem and make it an opportunity for you. And so that we don't dwell on it. So how can we face this challenge or whatever? So just remember, in 31, 32 years, all the things is my fifth bear market. Okay.
That's amazing.
So I've seen retirees through this time and time again.
Yeah.
So
yeah.
I kind of know the obstacles that are going to be ahead of us when we establish plans, and then my job is to help keep you on track.
Right. And if you're in a situation like you were discussing where you are sort of forced into retirement early, you're used to having that income, it can be challenging to stay on track. So what should we do?
Well, I know a lot of you are worried that you haven't saved enough or that you won't even be able to retire. I know that most of you don't have a written financial plan at all. And you know, the thing we want to do is we want to help you be more financially stable. So you don't have to be one of those people worried if you're going to run out of money, if it's going to last all through retirement. If you're listening to me right now and you don't have an income strategy, based on the statistics, but that's a tough one, you probably don't, I invite you to call so that we can help. We want to help you create a budget, create a retirement plan, live out your dreams, worry-free, uncover all your main risks that may be a threat to your retirement, including the inflation that we're in now, stock market risks, potential tax increases, skyrocketing healthcare insurance. Learn more about the options for generating income. Learn more how to keep your current standard of living in retirement, and even as costs keep rising. After we've analyzed this, we will have a plan to help you with your retirement.
That's a lot to look at,
That's
boy.
a lot of words.
It's a lot of words. It is, but you know what it is it's an income analysis. It's a great time to take a look at this. I ask why not, because worst case scenario, you're going to learn something by diving in and really understanding your picture for retirement.
Right.
We've got some things to do on the whiteboard after the break. I love it when you break out the whiteboard.
We got the whiteboard up.
So don't miss it. We came back, and Lowcountry Money Talk promised you a whiteboard. I love it when you break out the whiteboard.
I love it too.
We always deliver. When we promise, we deliver. But there's a lot we've been discussing on today's episode. We've been talking about taking distributions, income distributions. This is a big topic, of course. We're in a bear market. One thing that I have learned is that we need different strategies for bull and bear markets. So you're going to help us with that.
Absolutely.
Okay, good.
Very simple. So the way that the IRA distributions work, and we're going to use 2021 as an example, okay, because we lived through it. You will get a fair market value letter, okay? It will come in January the following year. So now you're getting 2022, but last year in January, you would get a fair market value letter, and it would tell you the value of your IRA at the end of that year. Okay, so that's the first thing we have to look at.
Right.
The second thing would be your age. I didn't write it on here. So it will be whatever your age is at the end of the current year, not the year before, to make it more confusing.
That is confusing, but okay, I'm with you.
Then you will have a divisor if you like to divide, or you have a multiplier if you prefer multiplication. And it will give you an amount based upon your age, your required minimum distribution, RMD.
Okay.
In this example, I'm using $20,000.
All right.
So we're going to say that we've got a fair market value letter dated 2021 that says our IRAs were worth $500,000.
Okay.
And our distribution by the end of 2022, based upon our age, is $20,000, and there was a penalty if we missed it and all that kind of stuff. We don't want to do that.
So the distribution is based on the fair market value and your age, and we're going to
In
use
the current
this.
year of what age you're going to be at the end
Coming
of the
up.
current year. Right.
Got it.
So we'll take that and we're like, okay, where do I take the money? Because the market in 2022, the S&P 500 index went down just a little under 20%. So for my example, I'm going to say that if we had everything in the bull market strategy, we would be down to 400,000. But there's a better way.
Yes.
So the better way would be to have split your IRA into two IRAs. The IRS does not care how many IRAs you have. They don't care which IRA you take your distribution from.
Oh.
As long as the total is whatever
they want that number coming out. Okay.
So we make two IRAs, Jessa.
Okay.
So we have one that's positioned for the bull market, which didn't happen, and then we have one that's positioned for the bear market. And very simple, whichever market we're in, that's where we'll take our distribution. So in this example, with a 20% decline, our bull portion, if we went down just the market, would be worth $200,000, not $250,000. But the fair market's based on a higher number, so
Right.
that works kind of against us because we're taking out a higher percentage. So in this case, we'll say, look, we don't want to take our distribution from here because our 200 then would become 180, and our market money for the bull needs to be a longer term. That way we can get market averages.
Right.
So in any 1 or 2 year period, when we have a downturn, well, we don't want to take any money out of it because that will affect what it grows to be later. So in the bear side, we place this in some type of asset that the worst it may do is a 0. So it can't lose what we originally put in there. So in this case, we would take our 20,000 from the 250 that's positioned there, assuming it didn't get any return. So we would have 230 here, and we would still have our 2 here. So we would be ready for the bull to recover eventually, and we would take our distribution from here. So we see the downturn here. Our gains on this side should look more like a stair step, but no negative returns there. This is the bull bear IRA strategy.
Is anyone else smiling inside? This is amazing. So smart. So the great news is if you don't have a plan like this, because it's very clear, we need 2 different plans, a strategy for either market. Go ahead and get that Revolutionary Wealth Review. They will help you establish a plan for either market. Really smart stuff. Phil,
Right.
thanks for joining us.
See you next time.
We'll see you next time on Lowcountry Money Talk.